Ladies and gentlemen of the crypto space, we're live on a Wednesday, September 13th at 11:46 a.m. Managing over the horizon, managing capital into the future means having different time horizons in mind and bucketing capital for those time horizons. Much like we look at different time horizons on chart data, we're able to have different considerations in mind when thinking about different buckets of capital. Obviously, cash savings is the ultimate short-term time horizon. How much cash savings do you have to finance monthly obligations for a period of time? Now, I've talked a lot about finding comfort, and that is probably one of the larger components of comfort. We could clearly have a fair amount of anxiety if our future is uncertain, and that's why we bucket capital hopefully most optimally in different time horizon components. Obviously, the longer term is trying to set up and alleviate discomfort and volatility and fears and uncertainties about a longer term future. And if the more breakdown, the more granular you get with this compartmentalization, the greater comfort you can find in the way you live life. That is probably the biggest driving force I've had in restructuring everything since the beginning of 2022, is comfort in mind. So time can pass. Time is what does all this work. Let me show you the charts that really contribute significantly to the way I think about things. And that's particularly the DXY in many regards. And structurally, looking at a 6-month chart is a very interesting perspective that I've talked about a lot. I mean, come on, you cannot manage capital from a 15-year time horizon. You cannot manage capital the way Brent Johnson talks about with the end game of the dollar, as I understand it, and I agree, being completely vertical, the complete disintegration of foreign fiat, the dollar goes to 300 and everything becomes dollarized. You can't manage capital based on those things, but that is quite the methodology and thought experiments to have with regard to the longer end of portfolio management. Target not even it's probably not even necessarily something you have to directly think about, but like Target 2030 is starting to think on those types of time frames of how to structure out into the future and what kind of composition that part of the portfolio can have. Obviously, stuff we do in the shorter time frames can extend out into the longer time frames, but it makes sense that different time frames have different things in mind that allow you to see significance in why you made those choices. What we're getting to is realizing that a lot of these things that I'm talking about are definitions. Us defining a time frame in mind and defining a purpose for that time frame, and because that time frame brings us a certain comfort. That's being the driving force. So 2030 for me, for many years at this point, has been a time frame in my mind, and I've have things since 2015, 2016 with that time frame. It was a 15-year time horizon at that point. Now, I wasn't thinking with regard to a 15-year time horizon at that point, but now as my methodologies have become more rigorous and I have these very well-defined definitions, oh, they're very much a 15-year time horizon considering when I entered those positions all those years ago. Now, more shorter term and very crypto-centric, I'm looking forward to 2H 2024 and Q1, Q2 2025. The expectation there is obviously the liquidity cycle rolls over and significant intervention is required. Refinancing of the global debt construct is required. Now, there's one thing that I don't account for is obviously the post-apocalyptic scenario with regard to weaponry and armament and food in a backyard and a bunker. So I'm not a bunker guy, but to many, that alleviates or facilitates comfort. So capital management isn't necessarily the only thing to do to facilitate comfort. If that's what you need to be comfortable, build a bunker. Grow shit in the backyard. Because talk about handling worst case scenario. This is all about handling worst case scenario. This is why Friday's conversation was about runway. How much capital do you need at this is what I think about very often, and I call it wake up money. If you ate ramen soup and it was like some crazy shit going on and you were not spending any money and you were living off bare minimum, like rock bottom, war breaks out and you're like, I'm not spending a fucking dollar, and you were living off ramen soup for a month. How much money is needed to wake up in the morning and stay in your home and pay your bills, so on and so forth? Wake up money. So I think a lot in those terms. So part of my 2025 time horizon is restructuring wake up money and meeting those expectations. And a lot of 2022 was spent on preparation for Q4 2024 such that wake up money in 2025 was going to be optimized. So runway, wake up money. How much cash do you have? How much cash do you make? This is one of the hardest parts of capital management is literally making sure you spend less than you make, is being quantitative about your capital expenditures, your capex. Make sure you're spending less than you make. And this channel has never been about like those types of financial conversations, but maybe considering the overall climate, it's not necessarily the worst thing for me to express those types of opinions. You shouldn't have bought the house if the mortgage was an adjustable rate. You shouldn't have bought the house if you were spending 50-60% of your monthly income on the mortgage. Yeah, I understand. I have a family, and I want my family to grow up in something interesting. But maybe that wasn't the right choice. Now, the first thing to do to move forward is to always correct wrong choices. And to do that, you need to be quantitative about capital availability. The reality is employment is a risk. There is no guarantee of that income. So how does that affect your emotional state? How does that affect your comfort level? Now, the most important thing, as we started this stream, positively contribute to your comfort level. You have to let time pass. So your investments, you can't raid your investments. Can't pillage your investments because now you're fucking up the longer term component of your portfolio. So you got to make sure you have short term covered and you structure towards midterm such that you could not screw up the long term. It's important and make those tough decisions. Hopefully, if there's an underwater house, considering the climate of the housing market, sell it. And I always tell my kids they're not allowed to move out until they're 30. Now, I understand everyone has different circumstances, but they're not allowed to move out until they're 30. They're not allowed to move out until they're trained by me in capital management. It's not allowed to. I'm not going to allow them to engage in life with that emotional burden of not being comfortable that things are under control. It's quantitative capital management, which means, okay, you're ready. That's what I would say to them when the time is right. Okay, you understand and you're ready and you could go because you have these types of time horizons in mind. You have these types of methodologies in mind such that you can engage with this Darwin system we have. So, I don't mean to step on cracks and upset people with these types of conversations, which is why I try to avoid them. And I can only imagine how bad it gets out there. Most human beings are not as emotionally well adjusted as I am and as stable as I am. And most parents are probably not inclined to say, "You're not moving out. You're not going anywhere." So everyone has their own burdens, and some people learn later in life, and they have to learn by themselves. To be honest, my father never gave me an education in capital management, and I probably learned the best aspects of my ability in my later 30s. I didn't get much education from my parents. They meant well, and they provided financially, and I didn't have to move out until I was much older in life. But I'm going to explicitly tell my children they're not going anywhere until they're ready. Um, so I guess maybe that point is sometimes it's easier if someone provides you training and someone provides you that type of guidance or expectation. You're not going anywhere, young lady. Or for myself was I had to realize these things on my own. Maybe that's lucky. Some people would probably define that as lucky. So interesting things in the markets. Frankly, the bond market looks like it's an absolute catastrophe with the leverage that's being placed on the system. Why? Because that's where the opportunity is. And they never expect an event, whether it's a credit event or some sort of liquidation cascade with some sort of leverage construct they put on the bond market, and volatility blows through the roof. And that would be an event. So, with regard to short term, my base case is there's a high likelihood of an event, which means you need cash to cover your monthly. There's no reason to not prepare for job loss. And if you're prepared for job loss, isn't that an interesting way to go through the day? All right, if the job's not here, I know this. I'm going to do this, this, and this. I'm good for this many months. I am prepared. Doesn't that make it easier to wake up in the morning? So my base case is there is a very high likelihood of an event of some kind that creates a significant amount of volatility, whether we see that volatility expressed in the bond market, which we'll see in the move indicator. That'll affect the currency market, and that'll affect risk assets. And then we head into 2024 with upwards of 10 and change trillion dollars that need to be refinanced, plus annual deficit spending. So you're talking about, 11.5 to 13 trillion dollars worth of bond issuance next year into a market where rates are doing this, into a market where sophisticated bond actors are leveraging the shit out of stuff. There's a lot of tinder there. There's a lot of risk. So it's going to be very interesting heading into next year. And that's the whole soft landing, hard landing narrative. If that occurs, it occurs. Be prepared for it to occur. There's nothing to do with regard to trying to capitalize on it, and that's what I like to teach, because that is work, and I want to teach folks to do things the way I want to do things. I don't want to work. I don't want to sit here looking at technicals trying to capitalize on a fucking credit event. I don't want to sit here trying to see where liquidation cascade occurs in crypto markets to get 20, 30, 40% and doing 50, 100x leverage. And I don't want to turn $1,000 into $1 million. That's some kid fantasy shit. I'm a grown ass adult. I want to do stuff that's sustainable, some stuff that's structured, stuff that doesn't require work. My objective is to click a damn button, several buttons, weekly, to receive income from shit I own. Now I'm going to live my life and make my choices and make my decisions with regard to where I invest based on what I want to achieve. So if those circumstances occur in the coming years, great. I click buttons a couple of times a week. And that is my midterm time horizon. Heading into the 2026, 27 bear market, 28 bear market, and everything goes to the upside, resettles, Bitcoin crashes to 50,000, and we're clicking buttons once a week in a market that's capitalized by $600 billion instead of 60-something billion dollars currently. And that's the wave. And I don't have any work to do. So the midterm time horizon brings me great excitement, where I'm like, okay, if I make the right short-term decisions, my midterm looks good. You're not investing now for now. That's the false reality of the leverage game. I'm excited for the future, and you live and bank based on the now. So we've still got a fair amount of income, some nice governance votes going on in the Curve DAO ecosystem. I think that CapEx right about now, albeit it's already reserved, but that doesn't mean anything. If someone is going to be actively engaging in those types of activities, they're going to want income, and Curve is an income. You need dollars to finance consumer staples and all those types of consumptions. So that's additional sell pressure. I think it was 140 million Curve is allocated to that potential activity. So that's nice, but I don't think that's necessarily the right time right now. I think things need to stabilize a bit more first before deploying such a quantity of capital. But I put in my 2 cents, and I think what I said is good for the long term. Finance things dollar denominated. That seems interesting, where people get salaries. Great, we can pay people. That's cool. We vote on that stuff. But you know what ends up emerging with these sub-DAOs is the same structure that happens everywhere. Government committees and subcommittees, university divisions and departments. It's the same substructure and the same type of capex. I'm not totally against it, but is it new and novel? I don't know. I think it'd be nice where, you know what may be better than these sub-DAOs is vested interest. They're contributing because they have their own vested interest and their own means of capitalizing, and by contributing, they're supporting indirectly their business, which is like what Frax is doing. Frax does what it does in these ecosystems because they are indirectly supporting themselves. They need the infrastructure that Curve has built for their business, their business's existentiality. So I like that even more. And honestly, that's an organic manifestation. Something like that is not executed or constructed or crafted. That is to organically emerge as the relationship between the parties. Tapsy's in the house, Dan's in the house, Sir Joe, Paul, doing a true public service on this channel with these streams. I'm trying. It's obviously a bear market, and I get light on content, but there's a lot of methodology and a lot of rules that I have crafted over the years. I remember years ago when I first started in maybe especially this space, but even earlier, folks always said rules, and I was like, what the fuck are the rules? Where do I look up this list of rules? And I've come to realize it's for you to define your own rules. And how do you know what is a good rule or a bad? And I don't know. The things that I tell you, the rules that I tell you, I know they're good. They're for me. They're my choices. But they came from experience. So I don't know how to tell that or teach that or express that to someone just getting into capital management, how I came to define these rules that I tell you guys, these methodologies. I don't know. But we continue, and I'm sure these rules and methodologies are going to evolve and iterate over time. I was about to ask you to look at some crypto charts until you said that you don't want to look at technicals. Technicals nowadays bring me comfort because it tells me current conditions. Current conditions are potentialities for paths, directionalities. Where are we heading? So on and so forth. So nice charts to look at are Ethereum, but not on the 6-month, weekly and the monthly. Higher lows thus far, albeit it's below the 200 and the 50 on the weekly. But that is a series of higher lows depending on how we close in 4 days. I'm not going to go down to the daily. On the monthly, we're above the 50 on the monthly, which is very nice to see. Don't want to see the TWAP turn into resistance. Thus far in the monthly, we have 17 days left. It turned red because we pushed below it. But if we push back above it and we close with a green TWAP, that's quite comforting, because if you zoom in and you see, a close above the TWAP on the monthly puts Ethereum into a breakout and a retest holding as support. And that's very early. Now, obviously, look at this time horizon. 1, 2, 3, 4, 5. That would be 6 months, 1/2 a year of your life to wait for a breakout and a retest. After a retest, a close above the TWAP, that means nothing. You need to wait for confirmation. You need to wait for confluence to assess directionality. What you want to see is the subsequent candle close above the close of the most previous candle, and that increases comfort that you understand the likely directionality. So those conditions, looking at those technicals, give you the information you need to see where we're heading, up or down. Bitcoin above the TWAP on the monthly, slightly below the 50. Let's go over to the weekly. Everyone likes the 200 on the weekly. We're below the 200 on the weekly, above the 50 on the weekly, below the TWAP. This is horizontal action, higher lows, which is comforting. Significant resistance above head. You can put up the volume charts to see what volumes are going on in this price action, to see if there's any gaps in the volumes. Note, on the weekly, we are bottomed on Stochastic RSI. Rate of change has pretty much bottomed as well, because we're going to see the compression, actually, if you look at that, higher lows, lower highs, which means you're just in a period of horizontal price action, crab price action. I expect hopefully a move. You're going to retest the 200, weekly 200, which is basically the weekly TWAP as well. Folks were talking about in the daily, the death cross, which is a 50 SMA cross of the 200 on the daily. Been below the TWAP on the daily. That's why there's too much noise in this shit. People are like, oh, death cross. Okay, wait for something significant on the weekly. But look where we are on the weekly. Death cross was back in February of 2023 on the weekly. What does the daily mean? We push, from a daily perspective, a death cross is like you push back down to the 50 on the weekly. All right? You're still, on average, higher lows. That's why the 50 SMA on the weekly is pointing up. That's why the Stochastic RSI is bottomed out on the weekly. If you go out to the monthly, coming off highs, is pretty weak. It's a pretty weak bump as compared to the bump we saw back in all-time highs, which is a bit disconcerting, but you could easily see a reset of Stochastic RSI literally bouncing off the monthly TWAP, depending on price action. And that would be interesting. And you could clearly put in bottoms, like you could literally say 15.6, 100 on the monthly. Why not? Still going to be a higher high, especially if you zoom out to the 3-month. I would like to see, this is actually quite meaningful to me, I would like to see the 3-month TWAP close above. So you're talking about one hell of a price point, and there's only 17 days on the 3-month candle. I'd be pretty disappointed to see this. On average, every 3 months, a purchase below the TWAP was a favorable price point, because you mean regress to the upside. The only time we were significantly below the TWAP on the 3-month was back in 2020, briefly. So this is obviously 3 months. So it's Q1 2020, January, February, March. And then liquidity obviously just brought us right back to the TWAP. So on average, a purchase below the TWAP on the 3-month is a favorable entry price. On average, if you're buying above the TWAP on the 3-month, that shit's going to mean regress. I mean, look at that. Look at that. That's pretty wild to actually see. Come on, someone buying a 19 and a mean regression down to 3,000. All right, it's clear as day. Below, on average, check back in 3 months, check back in 6 months. 6 months, this is actually concerning and comforting simultaneously. You never breach the 6 month, maybe early on, 13, 14, 15, 16. Very different market now, very different macroeconomic conditions, very different market. I mean, Bitcoin's not used as cash, even though I use it as cash, but the prevailing narrative is that it's a collateral type system. But a mean regression to the 6 month time weighted average price, there was, if you look at your portfolio every 6 months, it's never below the time weighted average price. And that's pretty interesting. Could easily see another mean regression down to 18 and change, but guess what? That's higher lows. And what do you think is going to occur in the next 1 year, which is literally 2 candles on this chart? You got 2024 refinance cycle. And look at the damn Stoke RSI on the 6 month chart for Bitcoin. This thing is bottomed. I mean, literally bottomed, turned up. Okay, look at that signal cross coming. So 1 or 2 candles is a year on this chart. Pretty interesting. This is another chart that's quite exciting. This is Ethereum denominated in Bitcoin. And look where we are from a technical standpoint. Maybe it's the monthly. Is it the 3 month that I was looking at that was getting peaked? Let's go over to the monthly. Let's go over to the weekly. It's the monthly, more or less. Excuse me. But look where we are from a technical standpoint. We are reset more or less to levels not seen since August of 2019, monthly chart. And August of 2019, we were down at the bottom of the triangular compression. And if we're reset to those levels all the way up here, it would take a pretty significant divergence or narrative change in the ecosystem to even see a mean regression to the 50 SMA on this monthly chart. So if you just have the right narrative or the right news event, you're going to see a divergence to the upside, especially with regard to the deflationary pressures that are presented on Ethereum since the merge. And we're still at 20 Gwei, so it's not like we're significantly inflationary at all. We have a significant reduction in circulating supply and a significant disruption on yearly issuance as compared to pre-merge. So there's already been a significant supply disruption to this asset. Now, obviously, many will argue that Bitcoin has appreciated significantly or depreciated less than Ethereum. Bitcoin has been relatively outperforming. That doesn't mean much for portfolio construction. That can mean something with regard to portfolio composition, where you favor one over the other, but now is not the time to favor one over the other. You favor one or the other. I was looking at a particular candle. Let me find it. Was it the weekly? No, no way. I saw a very large hangman, and I'm trying to remember where I saw it. Was it on the 6 month? Was it on the 6 month? No. Let's go over to the 3 month. Where's that damn hangman candle I was looking at? It was like, oh, okay. It's pretty obvious. 2 month? No, I don't know. But this isn't where I would swap to necessarily Bitcoin, even considering the depreciation. Got to remember, I got a different time horizon than folks. I don't mind the depreciation. This isn't a part of capital management that I require in the short term. But this looks wonderful from a Stoke RSI perspective, a rate of change perspective. This thing is basically horizontal for a long time now. Look at that rate of change, even back to September 2018, is basically flat, and you saw a significant appreciation in 17. So there's a big coiling occurring. Look at that, 2020. We're at November 2019 levels. I find that quite fascinating. That's good to see. Anywho, what other stuff you guys talking about? Hey, no, a long-time viewer, longer time curve holder. Hey, Shisha. I'm at brink of desperation. This shit is down only. What do you do in this dark time? Down over 95%. Okay, so I appreciate the darkness of the time. I myself have lost a fair amount of capital, but this teaches us how to manage capital in future cycles. You carve out capital when capital becomes available. You're obviously structured with regard to income, and that income you're saving. So it's accumulating to a degree. The income has come down significantly, but it's going to accumulate over the coming years, and that's meaningful. set your time horizons right. Probably the best thing I could say to pass the time is the beginning of this stream. That type of methodology, that type of mentality, that type of defining of rules. 95% down is not bad if you capitalize significantly in 2021, carved out a chunk of the portfolio in 2022. And, you know, there was a tweet a while ago. Someone said 3 cycles. It takes 3 liquidity cycles to get a sense of how to best manage things. And I think that was actually a really good number. First cycle, you're going to get wrecked. You have no idea what you're doing. You're going to lose everything. You're going to buy the bottom, not sell the top, and hold it all the way back to the bottom. Second cycle, you're going to make some capital, and you're going to preserve some capital. Maybe if you're lucky enough, you're going to capitalize on the way down. You're going to carve something out. That would be akin to like 2022, carving out like 15-20% of the portfolio and having some savings to invest and finance monthly expenses into the future to pass the time, let the time pass. So second cycle. Third cycle is where you have assets that you held through the second cycle, and those assets were well thought out. You were much more into the market and adjusted and investigative. So you have a structured portfolio, and that's going to do what it's going to do in the third cycle. So in many regards, I hope for folks, if this is going to be your second cycle in 25, whenever the heck it starts, try and leapfrog from the second cycle to the third cycle, and that really means like skipping over a lot of steps and defining a lot of rules and structuring things with different time horizons, and knowing, you sell things if you think they're going to go up, and you capitalize. And maybe you don't necessarily capitalize in a dollar denomination. You capitalize in Ethereum or Bitcoin, and that has a different volatility as compared to altcoins. But as I've said, I think my rule nowadays is I think of Bitcoin and Ethereum just as well as USDC. It's the cash position. And what you do during times is you adjust the cash position. Maybe some more USDC, especially as things start to significantly come down when everyone's like, oh, it's never going to come down. Yeah, it comes down. So you adjust accordingly. But those aren't investments. And that really helps me a lot lately. I don't think of them as investments anymore. Investments are tech, enterprise, cash flow, balance sheet inspection, value methodology, which hasn't really been around in equity markets in forever, and was really, laid out and matured by Buffett and his mentors and his inspirations of how to inspect what is value. And cash flow is valuable, which basically means anything that survives this frickin' cycle, in my opinion, is going to be very interesting in 2025. Okay, when I say 2025, that really shouldn't make folks need to adjust perspective that, okay, 2025, I know that seems like a long time. It's nothing. When you're in your 20s, maybe, I know a year and a half could sound like a long time. But fine, maybe I'm older than my age. I'm 40. It's nothing. A year and a half is nothing, guys. You prepare and you plan for a year and a half. Time is the hardest thing to manage, and your emotions, dealing with time, the better you're able to digest them, process them, and execute on them, the better your future will be. Time can be both a burden and could be powerful, because time is what does all of this work for us. You pick something and you give it time. We sure as hell picked a lot of things. Everyone that's in Discord and stuff, we have our picks. We're going to live with our picks. There's nothing we can do about our picks. And time is going to do what it's going to do. How about that? All righty. Get to the point where we're able to sit back and click buttons. Yes, of course. Even for myself. So I had very nice 22, and first, up until basically this month, I'm expecting a significant revenue decline this month. But up until this month, which is September, August and earlier, all of 22 is a very consistent monthly cash flow, which is very surprising. But I think we're getting towards the end stage, probably the next 6 months, 7, 8, maybe 2, 3 quarters, 9 months. I could expect decreases in monthly cash flow. But what do you think is going to be the next cycle or 2 cycles from now in the next by 2030, 2032? That's what I'm interested in because that's when you're. And what do I want then? I just want to click buttons. So I need to find an asset, whether it's an equity that pays dividends, but dividends are obviously getting rated by executives, by capex of human resources, by share buybacks, and whatever the fuck a company is doing subjectively in the boardroom. So I didn't want to do that. And that's why I've taken very much a liking to the crypto markets. Because I won't digress into that, but that's where you click buttons. Based on what? Contracts that don't have people, no people. So in 2 cycles from now, 8 years from now, if I'm clicking buttons, I made the right choices now. So then 8 years from now, you have a good dinner table story. How did you do this? Because we talked on this stream today, Wednesday, September 13th at 12:22 p.m., that in 8 years from now, we could remind ourselves the conversation we had today, that all we wanted to do was click buttons. Ain't that some shit? Great, CVX FXS. Let's do it. We rarely look at technicals. I miss the good days when we could find some easy peasy PvP ascending triangles. It's like 3 hits on a ceiling and it just blows up 30, 40, 50%. What do we do that with? Matic, I think. Those were interesting times. That's curve, which is just bottomed. This is not a technical chart to look at. This is a narrative. I posted a couple of comments on Twitter describing my sentiment, and it's like all those folks that bought OTC, yeah, they're millionaires and billionaires. You don't think they're going to defend their position? You think they're going to liquidate? Smart money doesn't sell at a loss. Smart money, yeah, you don't want to define it as buy on the way down. Right, maybe you would, but they defend their positions. They own, they dominate, they drive markets, they change direction. They create the markets when you have billions of dollars. So, not too worried about the damn asset. Where's CVX? CVX USDT 240. Should have waited for Olympus for me. All right, I would have saved 10 grand. Same narrative. Olympus is selling, but they're selling at a loss. What kind of retarded stuff is that? I don't mean to use that word. Well, that's forced selling. They're selling at a loss, obviously, because they're restructuring. Maybe they have capex requirements or whatever the hell it is. But who sells at a loss? That doesn't make any sense. So they're obviously being irrational, and that's what you need to account for, the irrational market actor. That's why when you see shit like this on the 6 month, let's go over to Bitcoin, you have more of a TWAP. That's why when you see shit like this, and you're that far deviated from the average price, that's the irrational market actor. It doesn't have these stories, these narratives, and they're hearing about it on the news, and and I would love to tell them stories and help folks do better, but the irrational market actor doesn't buy when it's depreciated, when it's below the average price and the mean regression is to the upside. They buy when it's significantly above the average price and the mean regression is to the downside, when there's a large part of the community that has a capacity to sell at profit. Whereas when you are deviated to the downside, and if you're selling at a loss, there's significantly less sell pressure because no one rationally sells at a loss. It's a mistake. You wait to be in profit. That's the whole point of PvP, capital gains trading. So the only reason you see depreciation below average prices is selling at a loss, which is irrational market behavior. And you can't account for that. This is probably the worst chart to look at. I would love to see more granular from a Uniswap perspective, but I'm not going to pull it up at the moment. It's just straight down. between, if you're thinking about it from like a an opportune entry price perspective, watch Olympus, and when they're done liquidating, I probably should have been more on that. Um, but you want to find the force sellers. Now, Binance is a big wild card. We'll see what happens. So there's this fair amount of potential selling to come heading into H2 2024. But that will be a fun time. Q3 2024, I have a good feeling. Q4 2024. Obviously, Q1 2025, we're going to know the answer to whatever the hell is going to happen in 2H 2024. FXS. All right, Dan, you got it. You got it. I mean, it's beaten up. Look, this thing's been straight. Look at this chart. It's straight horizontal since launch. What am I going to say about this chart? It's horizontal. What I like to do on charts like this is I take a rectangle and I say everything above that line is irrelevant. Look at that. Doesn't matter. Who gives a shit? That's the irrational behavior, deviated from the average price. Now, I'm not going to get granular and put up the SMAs and the TWAP. The price is horizontal. All right. So look what's being built. Check back in 4 years. You know why I get to say that? I have locked VFXS. I'm going to see what it's like in 4 years. There's nothing I can do about it. And I love that. Because I don't trust myself. I don't trust buying and selling. And I don't trust forced selling where I need the capital. And if you could sell it, at some point everyone sells everything. I love these locked positions. It alleviates an entire thought process of whether I can even sell it. And I've had a lot of flack about that. That doesn't mean much to me. What I care about is comfort. And if I don't have to burden myself whether I could buy it or sell it, to me, that's actually a monumental innovation. You can't do that with anything in the equities markets. You invest in bonds, you could sell the damn bond. Oh my God. Time lock. Now, I'm really surprised that Bitcoin doesn't really highlight that functionality of the base protocol more. Bitcoin has a capacity to have time locks where you cannot sell it if you wanted to. And that's, a little disappointing, or it is what it is, that it's not talked about, or it's not a feature or function that a protocol could craft a purchase and offer that configuration, is what it is. But I would think that that's a big thing. Time locks change the equation significantly. In my opinion, for IRL in real life transactions in the future, stablecoins should be used like cash, not Bitcoin or Ethereum. Yes, I agree. Settlement stablecoins. So there's a difference between settlement stablecoins and crypto eurodollars, synthetic collateralized debt positions, which is the vast majority of cash on the planet. So Bitcoin and Ethereum, I think of them in terms of euros, pounds, yen, yuan, just other currency. It's another denomination of an international currency unit. And if you want to make a payment at a retail store, you're going to exchange your foreign currency for a payment currency. And a payment currency is probably into the future going to be a dollar liability backed stablecoin where there's dollar liabilities in a bank account somewhere. Because the merchant will probably want to get paid in dollar liabilities. That's the heart. I was talking to a 26-year-old the other day about what the hell dollars are. And I was explaining to him what dollar liabilities are as compared to dollars, and his mind was fucking blown. So it's no easy process to acclimate to the realities of what these financial markets are. Understanding what dollars are is probably one of the first important steps, but man, these time horizons, that's like a re-education process. Um, why should BTC ETH be any different? No one uses gold for transactions. Sure, exactly. I agree. Gold is actually if you think of gold in terms of a foreign currency, it's a pretty shitty foreign currency. It's a pain in the ass. And don't get me started on like the inflation hedge or, even if it's currency inflation versus consumer price inflation, that narrative of Bitcoin, it's irrelevant to my point. It's a pain in the ass to sell to get dollars or dollar liabilities to finance expenses. Nobody does that, period. So it's a non-starter. You're absolutely right. But Bitcoin and Ethereum, in theory, you could have Bitcoin and Ethereum in your Juno account, and you swipe your debit card, and it automatically does the entire sequence of events to facilitate the payment. So that is something very different, which allows you to have foreign currency facilitate payment in terms of whatever the merchant desires. Seamless international currency units. Hope that clarifies a bit of my mentality. Is this market everything you buy go down only? Yeah, there's nothing to buy in this market until you start to see signs of a liquidity shift. And that liquidity shift, we're not at the point where we even know whether there's going to be a credit event or some sort of liquidity event in the bond market. And that's why we've been looking at the move indicator, and that's why we talk all this shit we're going to talk, and we set expectations. Like, look, that's your expectation. So you obviously bought, and you're like, oh, it's going down. But that really should be the expectation. So that's why I bought my convex, and I'm like, all right, what the fuck am I going to do? I should have been smarter. I'm not surprised it's going down. I wish it wasn't. But there's a more robust narrative in play. It's not just price. It's not technicals. There's a whole conversation to be had about literally just curve and convex, which is why we talk so much about it. So expectations, or what occurs not meeting expectations, is what leads to disappointment. So the most important thing is to get those expectations to be most reasonable and to not exceed what actually occurs. So I'm not surprised about the depreciation I experienced with the convex acquisition, but bear in mind, look, a lot of folks on the Lockbot, you see other folks taking on large CVX positions. You see the locks. We have the bots, the Twitter bots, the X bots. So other folks are doing the same thing. It depreciates. Olympus is doing what it's doing. Nothing I could do about it. It's a locked position. I've been alleviated. I've obviated the need for that mental contemplation of whatever emotional burden occurs often for many people. So this market, I would expect continued depreciation. You're not going to see significant appreciation. You see significant appreciation when liquidity turns positive sum. This is a negative sum environment. Negative sum means folks are capitalizing. Liquidity is draining. When you see this go up 1% a day, you'll see this go up 1% a day at some point in the future. And that's a positive sum environment. And that's when you're looking at ascending triangles. And that's when you could get easy PVP capital gains wins. And that's when you get to click a couple of buttons once a week and you're getting cash flow. Could you imagine the cash flow going 10x from here, 100x from here? So that's the time horizon in my mind, and that's what I look forward to. You're very welcome as always, Dan. Tape pusher. Old school McMahon, how are you? Hey, isn't it better to set limit orders than sitting and waiting for hints of direction reversal? Yes, from a trading perspective. I don't do that. I'm not sitting here looking at the technicals. I look at the technicals from a comfort perspective, and most of the time I'm working or I'm spending time with my children, teaching them how to round numbers to the nearest hundred because that's what they're doing. And that all seems so rudimentary as I'm trying to teach it to them. But that's just reminds me more how difficult it is to get from there to the types of conversations we have, and especially to my current understanding of the way things are. And I can only imagine how I'll be talking about markets in the coming decade. It's going to be an interesting ride, and I'll keep doing the streams, and we'll see this evolve over time. So, of course, limit orders, these are powerful tools. Stop losses, powerful tools. Twapping into positions, powerful tools. Look at what RT does at Hero Labs and his incredible, remarkable technical analysis skills. He's done very well. He is very impressive what he does. That is quality rules of engagement. So I would encourage folks to check out RT from Hero Labs. Do you think it's rational to sell a shitcoin that you don't think will make it into a core asset in the portfolio, or just sell to cash and wait for better times? That's the age-old question. Now, bear in mind, folks usually sell winners to diversify into something else. You know, your Tesla stock goes 10x on the money, and I'm going to sell some and buy this, and this. No, you sell the losers and buy the winners, and that's what creates the concentrated portfolio. Now, what matters is your runway. If you have 20 grand, 30 grand, however X amount of dollars that you need for X amount of months, and that is meeting your expectations, that you could find comfort, then you maybe concentrate. Maybe you buy the winners. And this is a good part of the exercise that I did in 2022, and especially all of this year. There's literally nothing in the portfolio that I could sell, really, to concentrate any further into things that I think will survive. Everything that I have in the portfolio, I think will survive. Never really owned anything that wasn't that didn't survive. Never owned anything that rugged or went to zero. It was all infrastructure. And as of thus far, everything I see that I own, I expect it to continue to be infrastructure. It has infrastructure written all over it, everything. So concentrate. And if you need additional capital, working capital to invest or to finance, to pay for things, but you folks really shouldn't need to sell assets to pay for things. This is a period of survival where you should be spending less money than you make from employment, such that you can do all these things and set the portfolio up structurally for the time horizons into the next cycle or two. So, food for thought. Hard choices. I know. I deal with them myself. Critical Mass is in the house. I appreciate all of you. Let's wrap it up for today. 23 people in the stream, 9 likes. Smack that thumbs up button. Tell everyone to subscribe. You know the deal. In the description is the link for the most rational community in the entire crypto space. I appreciate everyone that survives in there together. I wish you all a good day. I'll see you again on Friday. Peace.